Ladies and gentlemen, it is Growth Spark o'clock, and this is Growth Spark, where we ignite, accelerate, and grow. Please do not forget to subscribe, to like, and to share. Today, I want to talk about life insurance. What exactly is life insurance? Of course, a lot of people consume insurance, but the general insurance. What I want us to understand is that there are two major categories of insurance. There's the life insurance and the general insurance. Life insurance covers your life directly. General insurance covers property, the property that you own. So while life covers your life directly, and that is what we're going to be talking about, the general insurance will cover your property like your car, your household, your electronics, and so on and so forth. Life insurance is usually long-term, 5, 10, 15, 25 years. We even have a category or a type of life insurance called whole life insurance, which matures at death. General insurance, on the other end, is short-term. This is insurance that is renewed annually, like a medical insurance, although health insurance is basically a category on its own, given the size of business that comes from health insurance. So general insurance is renewable annually, like motor insurance, the insurance you take while you're insuring your property, and so on and so forth. So those are the two main differences. Life is long-term, covers your life. General is short-term and covers your property. Probably before I go deeper into what life insurance is and how it works, insurance basically is something that ensures that you remain at your original financial position. And in other words, we usually call that indemnity, where insurance can indemnify you. So you remain at your original financial position before a certain accident or incident happened. So if, for example, you got an accident, you are driving your car, you got an accident with your car, and your car is damaged, there's a certain financial position that you are in at that time. So if you have insurance, you will not have to go back to your pocket to look for money to repair your car. Because in the event that you don't have insurance, or probably you have something called a third-party insurance, and probably you're the one on the wrong, you'll have to look for money to repair your car. While you look for money, it means your original financial position before the accident will have gone down. So what insurance does is to indemnify you, is to make sure that you remain at your original financial position. Insurance also transfers risk from you to the insurer, so that in the event of a possible eventuality that was unforeseen, that risk is borne by the insurance company. So basically, you're protected and you are covered. Now, life insurance. The most basic reason for taking up a life insurance usually is for you to be covered, and also for your beneficiaries to be covered under that life insurance, such that in the event that you are not there. Now, because I'm not pitching to any client, I'll just say it as it is. In the event that you pass on, your beneficiaries are usually paid a lump sum that will help them continue with their lives, just as if you were still there. That is also basically just like indemnity. So they will not have to sell things, they will not have to lower their living standard, but they will be paid a certain lump sum so that their lifestyle or their living standards continue to remain where they were. A classic example is when a breadwinner passes on. Mostly a while back, I used to see when a breadwinner passes on, the family that is left behind, or the beneficiaries that are left behind, would really struggle to make ends meet. especially if the spouse who has been left behind or the wife who has been left behind did not have what we would call a stable job. Then it meant that for them to maintain the living standard that was set by the breadwinner, they would really struggle. In some cases, I used to see when a breadwinner passes on, and those days, the breadwinner was largely the man. It's not like these days. So when the breadwinner passes on, you'd actually see it would get to a point where the family that have been left behind would actually retreat to the rural home and stay there because they are unable to keep up with the standard that the breadwinner had put them at. So the converse is also true. If this breadwinner had life insurance, by the time they were passing on, then the beneficiaries would be paid by the insurance company a lump sum amount, such that even if this particular spouse did not have a stable job, they could probably open a business that would sustain them and ensure that they are at the same living standard that they were at. This money that is paid out from the insurance would still ensure that the kids remain at the school that they were put at by the breadwinner when he was alive. Okay, so at the end of the day, that was the basic purpose of life insurance. So how it works is simply by you as the principal member or as the client, let me just say client, when you go and buy a life insurance policy, you're expected to pay some premiums. You can pay the premiums monthly, quarterly, semi-annually, or even annually for a period of time. For whole life insurance, like I said, it matures at death. When you pass on is when now the payout is given to your beneficiaries. A lot of people usually ask, why should I save money or put money? Then other people come and use it when I'm not there. But these other people are your people, your beneficiaries. It is important that when you exit this earth, you leave them at a place where they do not suffer. Then there is, other than the whole life, there is also the term life insurance. So term life is for those people who do not want to wait until death. So you can take a term life insurance for 10 years, 20 years, 25 years. Then after 20 years, if something does not happen, then the payout is actually paid to you, and you can use that money for anything, do business, pay school fees, and so on and so forth. The other reason for having a life insurance policy is for the purposes of protection. A lot of life insurance policies nowadays come with other benefits like partial payouts, where you can actually be paid some money in between the life of the policy to help you sort out one or two things, maybe bills, maybe school fees, and so on and so forth. But also, most life insurance that we have today actually can even protect you or give you coverage in the event that during that life period or that period of the life insurance, you get critically ill. And by critical illness, I mean things like diabetes, cancers of this world, hypertension, and so on and so forth. In the event that probably you get an accident, and as a result of getting this accident, you are now permanently disabled. You are not in a position to generate income because now you are incapacitated. The life insurance will come through for you. In the event that even a loss of income is also covered under life insurance. So other than the first one that we talked about, where there's a payout to your beneficiary, even during this period where you've taken the policy, those things that I've mentioned, if they happen, you are also covered. Number 3, life insurance can also be taken for the purposes of helping you to plan your savings. as a savings plan. When you pay this in monthly or quarterly or whatever premiums to the insurance company for a certain period of time, you are actually building a savings culture. And while you save with that insurance policy, the insurance company usually invests those funds in various financial instruments that bear interest at the end of the day. So while you have an insurance policy, number one, your beneficiaries are covered in the event that you're not there, and number two, in the event that you have any accidents, critical illnesses, and so on, you are covered. Number three, also, it also works as a savings plan, that in the event that after the term is over, you'll be paid your lump sum plus the interest that has accrued. Lastly, number four, insurance can also be used for, life insurance can also be used for estate planning. Let's assume you have a business worth 10 million shillings and you have two children, for example. And these two children, one of them is so interested and is so into this business of yours, they're actually going to take it over from you. But there is this other child that is not at all interested in this business. In fact, they have picked or they have taken another line of interest away from your business. But you want that when you're no longer there, you are able to give these two children of yours equal inheritance, if I may use that word, so that there is no disputes later that oh, this business or this company was for our father, we must get equal share, and the one who is running it now demands that because they are the ones who are running, they must get the bigger share. So what you do in this business of yours that is worth 10 million, for example, you take up a life insurance policy with a sum assured of 10 million. In the event that you are not there, the business that is worth 10 million will be handed over. This is, of course, after you have given consent to that. The business will be handed over to that child of yours who has been interested in running this business. Then the life insurance policy will be given, the 10 million payout plus the interest will be given to this other child who has their interest on other things. So they can actually use that payout to further their interests and so on and so forth, while this other child of yours is actually continuing with their legacy in this business. Ladies and gentlemen, thank you for watching. Please don't forget to share, like, and subscribe. This is Growth Spark, where we ignite, accelerate, and grow.